Hello, everybody, and welcome to today's webinar. We're just going to wait for a final few attendees, and then we will start. Okay, I think we'll get started now. Today's webinar is about inflation surge, where to put your money. Obviously, inflation is a very topical subject across financial markets right now. And it's a real pleasure to have Jeremy Marshall from IP Global with myself. Jeremy, welcome. How are you?
I'm very well, Grant. Thank you very much.
Good to see you. And Ian, it's great to see you. Ian Pryor from IPP Financial Advisors in Singapore. Welcome, Ian. How are you?
Very good, thank you, Grant. Hi, Grant. Hi, Jeremy. Hi, everyone.
Hi.
Yeah, good to see you, Ian. As people may not know, we've worked together for many years, and obviously a great relationship between IP Global and IPP Financial Advisors. Obviously, two completely separate companies, but we have a very strong, trusted relationship. So welcome, Ian. Welcome, Jeremy. Right, let's go into the first slide, and I'm going to hand over to Jeremy at this point.
Yeah, thanks, Grant. This is just to give us some bit of context as to who we are as well while we're here. And I kind of see a lot of the names on the list here, and I think a lot of you are familiar with this. But just for those who, some of us are new to us, IPG is a investment company that deals in property around the world. We've been running for 16 years now and sold just under 6,000 properties to the value of about $3 billion there. So we're vastly experienced globally. We've bought and sold properties in 18 different countries, so seen all the good and the bad, the ugly that developers can throw at us in that time. But yeah, we're a full service outfit, so we help clients to build portfolios and then manage everything throughout the process. So our investment choices and our research teams are the real USP, and why we outperform. But then we can help with everything throughout the process in terms of mortgages and lawyers and lettings. So everything is kept under the same umbrella. Now, as Grant was saying, why we're here today, this is all about inflation, and it would be pretty impossible for anyone, probably why you're here today, to not have seen a lot of the news reports all over the world talking about quite potentially alarming looking inflation figures, particularly in the developed markets like EU and UK and USA. We're seeing figures kind of anywhere between 8-9% around there. So what today's about is a little bit of deconstructing this, what it really means to us as individuals, as investors, and for anyone who's doing investing. But the key takeaway really is that our money in our pockets is devaluing. It can buy less and less on a monthly basis. So thankfully, there are things we can do about that. Ian in particular then is going to give a good macro overview, and we're going to delve into that a little bit more about what we as individuals can do. So a little bit of history then and context as to how we come to be in this position, so people can understand it. And so, we all know we've been through the pandemic for the last couple of years at least, and throughout that time, obviously, there was a lot of uncertainty and a lot of worry potentially coming from governments. So what the central banks have done in that time is actually lowered interest rates fairly dramatically to really try and stimulate all the individual economies. In an ideal developed market target, what they want to see is 2% inflation rates. And so lowering the cost of borrowing means that your average Joe and everyone has easier access to money, can spend easier, and so they really wanted to keep that up. They didn't quite meet the 2% inflation rate at that time, but what we've seen now is, in context of, say, previous times when there was worries of recession, like in 2007 with the global financial crisis, that was a credit crunch, and there was a lot less banks giving a lot less money in market. But this one was a health crisis. So when we've come out the backside of it, the back end of it even, then what we've seen now is a big surge with people being able to spend money. The money has still been cheap to borrow, and so inflation is happening. So yeah, perhaps we move on to the next slide. So here then what we're going to see is expectations over the next couple of years and going forward, and trying to put this into context of where we've been. So we can see at the bottom there the interest rates for the UK, the ECB, and the US have been historically low, dating back to absolutely decades. So it's been the cheapest possible time to borrow money. People might be considering that for their mortgage rates, so they might be going up. But we have to realise actually, compared to long-term averages, these are still very attractive. And even if we can see that the year-end forecast of rates still going up, what we're going to try and show here is that actually compared to inflation rates, that actually this still means that it's incredibly cheap time to borrow. So even if we're seeing the rates going up to, let's say, 2.2% in the UK, your real level of what you're doing with your money is a lot more preferable to take that finance in regards to having your real asset, essentially. So that asset should be growing above having your money in the bank. So now I think we're going to pass to Ian, who's the expert in terms of the macros and can give a bit of an idea then of what that's going to look like, why we've come to be here, and what the future might hold in terms of these inflation rates and how long we might be in this environment.
Yeah, sure. Thank you, Jeremy. So really what this slide is showing, the main visual, I guess, is to illustrate really how high inflation is relative to the last decade or so. You can see, obviously, headline inflation, which is the red line, which is what gets reported in the news articles that we've all seen. It's really spiked. I think we all know why we've got there, why there is inflation. But just as a quick sort of summary, because obviously a lot has happened, I guess it all starts with COVID. And we know that with COVID came lockdowns, and no one really knew what the deal was and what the risks were and what to do. And with lockdowns, and particularly actually in China, because still a lot of products and services come out of China. So when we had lockdowns, many factories closed, and that creates a supply chain freeze as well. So it just means that the raw materials and the parts and whatever is actually created in China just can't get to the next place in order to produce the products that we as consumers would buy. So that delay obviously causes, I guess, a supply and demand mismatch. Add to that, obviously, borders closing. Every country had a different policy, still does, and it is constantly changing, and still is, in fact. So that obviously creates problems with logistics, and we all rely and take for granted our Amazon Prime same-day delivery. That just simply wasn't possible during COVID, and of course across international borders. So that obviously helped push, the prices of goods and products upwards. But it wasn't just that. It was also labor movement could not move freely. I know here in Singapore, where I live, a lot of laborers actually live in Malaysia, and of course they couldn't cross the border. So guess what? There's less supply, the demand is the same or even higher, and therefore the prices go up. So that's why we see this very, very sharp line going up around COVID times to where we are today. It's not just obviously COVID. We then had the Ukraine conflict when Russia invaded Ukraine earlier this year, and that naturally caused and still is causing the cost of oil and gas to go through the roof. Russia is a major supplier of oil and gas to the world, particularly in Europe, actually, but also Ukraine as well. Ukraine has huge amounts of natural resources, particularly actually in the agricultural part of things. So again, food prices, food supply, these have really gone up very, very quickly, and probably, haven't peaked yet in that sense. And also, it's not just that. You also have a lot of industrial and base metals that come out of Russia, and to a smaller degree, Ukraine. So again, we've just seen commodity prices spike very, very quickly. So that's kind of how we got there. You know, it's not just going to be the actual goods, the manufactured products, if you like, that the prices are going to increase or have increased. It's going to be services as well. Good example could be flights. Flight costs are likely to increase a lot. They have already started. I would imagine that trend to continue for a number of months. Why? Because planes need fuel to fly. Fuel is much more expensive. Borders have been closed for so long or restricted, and now they're opening up. Everyone wants to fly away on holiday. I know I want to. So yeah, this is what's caused the inflation, and this is what's going to cause it to stay. So I guess the question is, has it peaked? Is it peaking? Is it going to be with us for many, many years, like it was in the 70s and 80s? Well, I don't know. What I can say, though, if we can go to the next slide, please. We've got some data here just focusing on the US inflation rates. So this was the headline that we saw in Jeremy's slide in April, was 8.3%. Just released actually on Friday last week. It's gone up for the month of May to 8.6%. So it certainly hadn't peaked. I'm not saying it's peaked now. We just simply don't know. But what this shows is the inflation rate that's reported, the number that we see in the headlines, is based on that same month in the previous year. And just here, we've just highlighted March, April, and May, which were the recent ones. And you can see that was actually really where it started picking up quite quickly. And what it means is that in order for inflation to keep increasing, so i.e. when we see June and July and August figures being reported, it's on a much higher base. You know, we're looking at 5% plus 6%, going up to 6.8, 7.1%. So it's not just prices have to increase, they have to increase really quite significantly at an ever-growing level. So I don't want to stick my neck out and say inflation's peaked, but I would say it's likely to be peaking simply because the base on which it's calculated on is increasing at a rapid rate already. So yeah, I don't want to say it's peaked, but I think it could well be peaking. We'll just have to see what happens with the next reports. If we can go on to the next slide, I want to just, I guess, hammer home how important inflation is, not just from an investing perspective, but from a day-to-day, what affects us. You know, we can read a report about US CPI being 8.6%, but what does that mean? I mean, it doesn't really mean anything to us in the real world. So put here just 8.3%. Well, it's not, it's now 8.6%. As I just said, economic data is backward looking and it's always changing and it's always coming out. But what shocked me was having a client meeting in Starbucks, and I bought her a coffee, and that's fine. It was $7.20 for a flat white. Now, a small one as well. That's just extraordinary. And I know Starbucks has been shut for a while. I haven't had many face-to-face meetings for a while, but it hasn't been that long, has it? I'm sure it used to be $6 or even $5.80 or something like that. So again, is inflation really 8.3% or 8.6% now? I'm not sure. Starbucks, $6 to $7.20 is about 16 odd percent. That's double. Interesting point here is actually the price of coffee, depending on when you look at it, because it's obviously very volatile, but as of a couple of days ago, was actually flat year to date. It hasn't gone up. So this is really, you can see how inflation is passed on to us as the end consumer. Obviously, it costs more money for Starbucks to send their coffee to their stores and, you know, the logistics of the supply, basically. And that cost is being passed on to us. And the reason why I want to highlight this is because it's important we understand how real inflation is and how it does actually affect us rather than just reading news headlines. But also how important it is to make sure our money is keeping up with inflation. A lot of people just think about investment returns, but the most important first thing to do is to keep up with inflation. And that's obviously why you're all here and what we'll get into a bit more later. I'm not going to dwell on the cost of petrol, and that's British Gas's new logo, if you didn't recognize it. We all know they're going up. I think every pump in the world is getting more expensive. Even speaking to someone in Dubai recently, where I just assumed price of petrol would be cheap. Well, it's still cheap relatively, but it's going up as well. I know, having family in the UK, that my parents' home in North London, their utility bill went up 3 times, not on 3 occasions, but 3 times, 3x. Went from 100 and something pounds a month to 300 and something. I think it's 360 pounds even. That's a huge increase. That's not 8.3 or 8.6%. And then I've just got their SB whole chicken. It's a bit of a local story. Conscious that people are from around the world here, but Malaysia has seen its price of chicken increase a lot, and it wants to protect its people, and therefore stopped the export of chickens. Now, Singapore relies on Malaysia for a lot of its goods. So you can see here, the cost of a chicken at the end of May this year was $72.27. It's actually 2 chickens. It was a mislabel and it caused a bit of a social media storm, but okay, that's still $35 for a chicken, uncooked, by the way. So you still need to use gas to cook it. But yeah, that's extraordinary. And, for those that aren't in Singapore, not familiar with the Singapore dollar, $35 a chicken, you're talking about, what, 17, 18 pounds? Yeah, extraordinary. So yeah, I just wanted to highlight how real inflation really was, and yeah, why we really do need to do something about it in terms of making sure our money goes up. People look at investments. Is my money going to grow or is it going to go down? Oh, I'll just leave it in the bank. Everything's quite risky now. But what people forget is that value, the purchasing power of that money in the bank, is going down, and it's going down at 8.6% per annum at the moment. So keeping cash in the bank is probably not that smart. And I guess it's, what do we do with it then? So I think the next slide will give you all the answers. This is the juicy bit. No, I mean, look, it's quite obvious. So we've got the 4 sort of main asset classes, if you like, that we look at on a day-to-day basis. As I said, cash, it just doesn't keep up with inflation. Your cash is losing value literally as we speak. Even if you were to put it into a deposit, even though we've talked about, we know interest rates are going to rise, and they're going to rise quite quickly as a way to combat inflation. But are they really going to go much above 3%? I'll talk about bonds in a second. Do we believe that, the European Central Bank, the Bank of England, and the US government, do we believe that they want bonds at 3% plus, 4% plus, 5% plus? No, they need money. Every government in the world, particularly the Western governments, need money. And they do that obviously by creating debt and raising money through the bond markets. They don't want to service that debt at 3, 4, 5%. They quite like servicing it at 0 to 0.5 to 1. So even if rates do go up, I don't think they're going to go very high, and I don't think they're going to stay high for that long either. So end of the day, cash in the bank doesn't yield anything. In Europe, of course, it's negative. You're charged to keep cash in the bank. So that's one thing to consider. And like I said, bonds, even though with the expectations of interest rates going up very, very quickly, as of yesterday, the 10-year US Treasury bill yield was 3.41%. So that's 3.41%, and we're talking about inflation at 8.6%. It just does not make financial sense to me. So what have you got left? You've got stocks. Obviously, the concern is that the stock markets are risky. They're very volatile. Now is a very uncertain time. And that's true. It is, it is uncertain. I don't think we've seen the bottom of the stock market. I think we've got max pain still to come. But having said that, when I look at stocks today, I look at the S&P 500, which is the 500 largest companies in the US, and the average dividend yield is 1.66%. Now, that's not exciting, but it's better than I get on my cash in the bank. So you're being paid more by publicly listed companies to hold their stock. And of course, there's volatility, but volatility works both ways. So next month could be bad. Next quarter could be worse. Next year, maybe. I don't think it will last that long personally, but next year could also be bad. But at the end of the day, from the very beginning of the Dow Jones Industrial Index, which is probably the longest sort of official history of any major stock market in the world, from its very initial inception over 100 years ago, it has averaged 10% per annum returns. So that's going to keep up with inflation. That's going to beat inflation, in fact. And then the other asset class is real assets, which again is part of the reason why we're here. Property, I'd like to know a bit more of the details from Grant and Jeremy, but property has kept up with inflation. And I know over the years, again, if we look back at the high inflation years in the US in the 70s and 80s, real estate in America averaged for 5 years during that high inflation period, 10% per annum growth. So it does keep up with it. If we can go to the next slide, please. I just want to elaborate a bit on real assets. Obviously, property is one asset class that you're all here, myself included, to learn more about today. But I think normally when you talk about inflation, most people talk about gold. It's a store of value. It's the classic inflation hedge. You know, I learned about it at university doing economics. It strangely hasn't done that well. It's actually only up about 0.9% in the last year. Year to date. And that's interesting, but I think the main reason is because it's priced in US dollars. Now, of course, the US dollar versus a basket of currencies, so if you look at the US dollar index, you know, that's up 15% in the past 12 months. So gold is still holding its weight. It is still being an inflation hedge. And I think actually gold will probably pick up in the next 12 months quite a bit. Speaking of gold, there's a gold Rolex there. I'm going to save that one to last though, because I just want to very quickly talk about whiskey. So that's a 1926 Macallan in that picture. I have no idea how much that's cost, but I can guarantee you over the past 10 years, its value has risen far above inflation. Actually, Knight Frank do a luxury goods index, and Schroders, who's an investment manager that we use, recently sent a report. I think it was in April this year, and the average, the total return on the average fine whiskey in the past 10 years has been 483%. So when we talk about real assets, it's not just property and it's not just gold. It's things like watches, it's luxury items as well, and things like whiskey and wine you could put in as well. I don't have the numbers or statistics, but I know designer handbags, vintage cars, these have all seen massive price inflation around the world. And the final one, before we go on to property, I guess, is Rolexes, and not just Rolexes, I guess high-end luxury watches. What a great investment. A Rolex bought in November last year could have sold quite easily in February or March this year for over 2 times its price. If it was rose gold, it would be between 3 and 4 times its price. And that hasn't come down. Now, that's a great investment. So you're probably all thinking, well, Ian, why am I going to invest stocks with you? Why am I going to buy a property for IP Global? I'll just go and buy some new Rolexes. Well, the problem we have, again, is this supply and demand. There is not a single, that I'm aware of, a single man's new Rolex available to buy in any Rolex authorized dealer in the world. You can't buy it. You need to be on a waiting list, you need to be on a VIP priority list, and then you might get one at some point. So yes, it is a very good investment. It's just very hard to find. Much easier to find, and again, why we're here today, property. I'd be interested to hear actually how property has fared in previous high inflation environments, and if it's still worth buying now, given the inflation expectations. Grant, I think you were going to talk us through some of that.
Thanks, Ian. Yeah, that was very insightful. And perhaps when I next come down to Singapore, we won't go to Starbucks for the coffee. We'll come to your office. Should be a bit cheaper. Yeah, thank you.
I'll charge you less, Grant. Yeah.
that was very very interesting indeed. Thank you. So yeah, I'm just going to touch on the interest rate inflation environment. So, when I think back to when my dad had a mortgage in 1988, he was paying 15% interest rates, huge interest rates, and that ultimately had an impact on property markets. Property markets started to come off. Affordability levels were extremely stretched. So, just taking a snapshot on this graph below, if we go from sort of 1995, we will see that average UK mortgage rates were around about 8%. But inflation was around about 2.4%. Now, if we look at sort of where we are in real time today, I mean, we shared the fact that inflation is actually 9%. In fact, depending on unofficial surveys, you can actually see arguably that will be higher in the UK right now. But in effect, average mortgage rates veer between sort of 2.5 and 2.6%. So, based on inflation versus interest rates, you can actually argue that you're paid to borrow money. We're in a very sort of negative real interest rate environment, and in effect, with interest rates being so historically low, in effect, affordability is still very, very good indeed, and that is really relevant to property, really strongly underpinning the property market, the fact that rates are so low, and we're into this inflationary environment that impacts very, very positively on property. I mean, we know that land prices are going up, raw materials are going up, etc. So specifically relevant to property, we know that the next building is going to be more expensive than the last building because of the raw materials impact of inflation and also land prices, etc. So, that is why, as a business, IP Global, we are seeing a very strong interest from investors into property investment right now. And as I say, the excellent affordability given low interest rates and obviously inflation being such a positive impactor on property is really helping that asset class right now, amongst other asset classes that, of course, Ian has mentioned. When we're looking holistically, we see the positive benefits of inflation in the investment environment. So if we go on to the next slide, just really want to touch on the fact that real estate really is an excellent hedge against inflation. I mean, if we look at how property prices have gone right away from 2005, I mean, of course, we would have seen a dip during the financial crisis. And then sort of from 2009, we started to see recovery through January 2011. And in effect, where we are now with this inflationary environment, we see property prices that have exceeded the consumer price index and the retail price index. And then if we throw in some other stats and look at the positive nature of the property environment right now, I was actually looking at the statistics under the Department for Levelling Up, the new government department, showing the amount of property built from 1995 to the latest figures that are actually 2020, 2021. Now, depending on what survey you read, the UK needs 250,000 to 300,000 properties a year. But every year in that, in those annual statistics, it's never reached anywhere near 250,000. Indeed, the latest statistics are that there was 216,000 properties built in the 2020-2021 year, which is 11% down on the previous year. And of course, we know that with COVID, town planners haven't been meeting, projects therefore haven't been signed up, and there is a lot less stock in the market. So when the new figures come out in November 2022, I'll be very interested to see what the latest stats are. So, we have the inflationary environment that is affecting obviously raw materials, land prices, etc., which is positive for property. And then we see that very strong, consistent undersupply in the UK, which has always been there. It's a feature of archaic planning rules and regulations. but it's been heightened obviously during COVID. And as I say, it's one of the core reasons that underpins the market, the supply v demand dynamic, and keeps the UK market very strong. So let's go on to the next slide. And just here, I really just wanted to touch on impacts of currency. Because as Ian mentioned, in the Eurozone, obviously we've seen very low interest rates. We've seen interest rates go up in the UK, in the US, but not the Eurozone as yet. They're planned to go up in July. But what that's meant is, in effect, for those who are looking to invest into the Eurozone, the euro has weakened against a basket of currencies. We've highlighted the US dollar here, but of course we could highlight a number of other currencies, Hong Kong dollar, Sing dollar, and others. But just very simply, as one snapshot, we see over the past year, the USD, which obviously a lot of our clients are paid in across the Middle East, where Jeremy is, and here in Hong Kong and other markets, 13.9%. The euro is weaker against the USD, so adds more bargaining power to your investment into the Eurozone. And of course, we could have highlighted the strength of the USD, the Sing dollar, Hong Kong dollar, dirham, against the GBP as well, and highlighting the effect that currency plays in of course property investing. So let's just move on to into the next slide. And at this point, I'm going to hand back to Jeremy to just talk about the high level macro micros, obviously relevant to property.
Thanks, Grant. And just to recap a couple of things you were saying there, because I think you hit the nail on the head with a couple of those points. And I think effectively it's just to see what the environment we find ourselves in there. So yes, the last slide, we've got, the currency is very much going in favor, particularly for clients in the area I work in the Middle East here, who are mostly pegged to the dollar. So effectively getting a real discount on, the same time last year, and you can buy more for your money. And then that the finance perspective in terms of the interest rates, as much as they might be going up a little bit from the base rate from the central banks in relation to what's happening with inflation. If we're buying the right properties, then actually we're in as cheap as finance times as you ever could find in terms of negative rates in real terms. But particularly what's in relation to this slide here was your comments on supply and demand, which is fundamental to any property investment. And so it's not just a case of saying, fine, I understand property is a good idea, I'll buy into that. You can't just go and buy any property. If you're going to buy something which is going to match and beat inflation, you have to buy the right property. And so this is what our research and investment teams do, is look at essentially all these bits of data on this page is what we need to be in place before we then go and buy buildings around the world. So and whether that's in Europe or UK, where we're majorly focused on lots of different cities in UK and on some of them in Germany and elsewhere. Supply and demand is the backbone of any fundamentally good property investment. You need more people, more properties. More people than available properties in any given area. And if we're looking at the parts of this slide here, population demographics, you want there to be a decent array of different jobs and those people to individually have decent wealth. So it's not just a case of saying, fine, I can afford that property, let's go for that. We have to know that it's in the area which is going to be in most demand for both local people living there and investors there. So we can ensure that it's always going to have demand for renters, which is going to be paying off your mortgage over the time, and it's going to have that pressure and demand to push the price up over time to match and beat inflation there. And this is why we're, as a company, looking into Germany and the UK mainly, because say the economic outlook there is much more predictable. These aren't frontier markets, some of the kind of most long-term established markets, and then we can predict then comfortably what the kind of expected growth rate should be, because we know there is so much pressure on market there. And then the other things here, which are potentially straightforward and you'd think very obvious, but they have to be considered. who are you buying from, making sure you're buying someone who's got the finance to definitely deliver these projects. That's something which can come up in a turbulent time. Make sure all the legals are fine, and making sure that comparable prices in that good area you found match up to what else is being offered on market, because you don't want to overpay, even in a time when assets are regularly appreciating. So it's just about doing your DD, in the same way that we do as an investment company, or the same way you would do as an individual buying. It's definitely a great asset class to be in. You've just got to make sure you're buying the right thing at this time. So yeah, leading on to, just as an example, as I say, we are doing Germany as well, but these are just some of the most recent assets that we purchased as a company. Starting with Cooper House on the left here. This is in Hull, which is in UK terms, for some people's eyes, probably a frontier market, but this is exactly what we do as a company. We're looking for that next level of value, which hasn't necessarily yet kind of run through its property cycle, and you can't find good value there anymore. So everything here, in my opinion, we're looking for value. So particularly for Hull, let's say we're looking at under £300 a square foot, which increasingly is going to get hard for developers to build at that price over the coming years. And equally, we match that then with all the factors we were talking before about a big regeneration market, a city of the future. Hull in particular is very much focused on green renewable energies, and there's hundreds of millions of pounds being spread into that market in particular. And then the other markets here, we've got Century Square in Manchester and Silversmiths in Birmingham, which I'm sure will be very familiar to lots of the people on this call about what the stability and outlook basically for those two cities. But Grant, I don't know if you want to elaborate particularly any of your favourites that we've had probably in the last year, or any of these ones.
Yeah, I think what you were saying, Jeremy, on the earlier slide is very relevant to each of these opportunities basically, and all of the opportunities that we do at IP Global. It is very much looking at supply v demand. It's about looking at obviously the regeneration story, the infrastructure, rental market, etc. Each of these, as we know, Silversmiths in Birmingham. Birmingham is undergoing an incredible change. I was sort of blown away when I was there in 2020, having not been there for many years. And obviously that would have moved on considerably over the last few years. And then, if you go to obviously the likes of Manchester, where we've recently launched, so much job creation moving up from London. We talk about the fact that, with a better infrastructure, etc. there, you've got people on sort of 75% of London salaries, but paying 50% of the prices. So, again, sort of affordability, one of the things that, was relevant on your slide is applicable there. And then just, to your point as well, Cooper House Hull, Hull many years ago, you really wouldn't have given it a second look. And it's not the finished article now, but it's not too early, it's not too late. It's kind of on that mid-tier where it's really growing and thriving into a renewable energy sector of the UK. With the Yorkshire Energy Park and Siemens investing heavily, etc. And then, just the final point I would add is, of course, again, supply v demand. When we look at the rental market in the UK, we as we manage 5,000 properties, and at the moment we've got well under 0.5% as a vacancy rate. We've got our strongest sort of rents coming through, and again, that's due to sort of pent up demand being released post pandemic, people renting that first property that are put off for the couple of years during the lockdowns, lack of stock coming to market. So it's a very healthy inflationary environment on the rental market. So, they would be obviously just some of my sort of immediate comments, Jeremy. I don't know if you want to add anything else.
Yeah, no, I think it's a ever evolving organic thing in terms of where we look. We've got a fairly kind of scientific process, and the key word is always value there. Where effectively can we see outperforming growth for a stable market like the UK over the next decade. And so, that might well be, that we'll go into something in London again. London was a huge thing for us in, up to probably about 2015, 16 when Brexit was called. But then we kind of logically stepped away and looked for, the secondary cities like Manchester and Birmingham first. And then, incrementally, we've been reaching out further to those other markets, which have been essentially booming in their post industrial collapse phases, when those markets all in the 70s and 80s were getting quite poor, and they're seeing their huge rebound now. So as we're seeing really large scale investment coming from international companies into some of these, it gets us into that safety margin. We're like, yes, now is the time, because it's cheap enough still, it's super safe enough now, because all these good companies, all these good employers are coming to that market, and now we've got the best opportunity for growth over the next 10 years. So we're super careful about when we enter market. Like Hull, we've been looking at it for the last couple of years, but it's really only when some of these larger corporations committed these big funds and these big projects there, we're like, yes, no, that's it. And so it might well be that it'll be in London and so forth, but you have to just be a little bit more careful. The prices are there are already, very high. So we'd be looking at, not exactly discounts. You're never going to find that in market, but like compared to, prices pre when they had a bit of a tumble there. So it can be anywhere, but we just have to keep going back to our principles at the beginning. What's safe, what's reliable, what's going to make money over the time, because that it's always going to get rented out, and there's healthy demand across, a number of different sectors for those properties. So yeah, I've actually been seeing, there have been a number of questions been coming through. Didn't kind of specifically mention that, to write questions in there, but feel free. If there's anything specific you've heard today which you'd like us to elaborate on more, then do ask. But we'll try and cover what we can. Look, I don't think we'll have time for everything, so by all means, we will get in touch with you afterwards if you've got specific questions we can help with. But look, this is one. I think this one will go to Ian, because I think this is probably more your forte there. Saying, you mentioned the the real assets and stocks and shares potentially being some of the best assets to look at in an inflationary environment, but there's been no mention of crypto or Bitcoin in this environment here. And where does that sit in the pantheon investments? And good, bad, ugly, what do you call it?
Yeah, I wouldn't say I was an expert on cryptocurrency, but look, it's an asset class I get asked about every day. We talk about it. I think nearly everybody I know does something with it. In terms of real assets and an inflation hedge, though, I mean, look, there's just no history. I mean, it only came to market in 2009. Inflation, if I'm not wrong, hasn't been above 3% in that period. So how can we possibly say it's an inflation hedge? Sure, supply and demand story maybe, but I think at the end of the day, I talked about stocks. That's because the Dow Jones has got over a century track record. I talked about gold. Gold, obviously, the 70s and 80s were quite a unique inflationary period, particularly in the US. But in that decade, gold went from $40, $42, $45 up to 400. Actually, it went up to about 850 in a brief spike, and came back to normal numbers at about 450. That's a huge increase in that period, and that's really the only really severe inflationary period we can compare things to. So yeah, at the end of the day, I just feel that it has a place, sure. Maybe a small sort of 1 to 5% of liquid portfolio for speculation on the future, etc. Yeah, sure. As an inflation hedge for a large proportion of someone's net worth, I'd say definitely not. I think the risks are too high. The history is not there. Yeah, gold is flat year to date. Bitcoin is minus 50, 55% down. I mean, from highs, it's probably 75% down. I mean, that's not an inflation hedge, right? So yeah, that's why I didn't mention it.
Yeah, that sounds like some good logic, I'd say. Decent answer. Grant, how about this one for you? Like, what market, given the current environment and climate, would you suggest is the best to invest in terms of a property market?
I think, just picking up on your slide, Jeremy, I think any market that demonstrates those key sort of 10 to 12 factors that we look at is a market well worth studying and reviewing and potentially investing in. I mean, obviously, from our side, having done all the significant research and due diligence, and the fact that, we've done over 100 projects in the UK, Germany, we've done 150 million euros of investment. I mean, Germany, UK, I have to say, are two markets that, I really do like, because they have the very strong fundamentals, particularly in today's uncertain world we look at. And as I say, those strong under fundamentals are supply v demand. I mean, we talk about the UK are structurally undersupplied. Germany is structurally undersupplied from a property perspective. In fact, Germany, with its open door policy as part of its constitution, continues to see significant population growth. So, with that supply v demand dynamic across both those markets, they're both sort of very attractive. And as you know, they're markets that we have been focusing for some time and will continue to focus on. But, just throwing in alongside that, rule of law, so great legal structure in terms of property investing. There are tax benefits, obviously, for UK with your personal allowance. For Germany, if you hold for 10 years, there's no capital gains tax. You can offset your mortgage interest to your rent. And, regeneration, as you mentioned, I mean, regeneration we know is extensive across the UK in the big cities across Birmingham, Manchester, Liverpool, Leeds, etc. Part of that is through HS2. But also, in Germany, in the core cities that we've been focusing on, we've seen Berlin revolutionized over the last sort of 20 or 30 years. We see, Leipzig, where we're focusing as fastest growing city in Germany, in a tremendous sort of 20-year plan. And obviously we're reviewing other German cities. So bit of a long-winded answer, but, I just think we are focused on the right markets across, UK, Germany, because of the strong economic fundamentals and the supply v demand imbalance that is great for capital appreciation and great for rental growth as well.
Exactly. I think, if it's a long answer, it's absolutely correct to be, because I think, it just goes to show how many variables there are potentially when you are going to go be buying into a market. And, our outlook is potentially very much global, so it's no coincidence that actually we do narrow down to Germany and the UK as our preferred places. I mean, we're putting our own money into it, for liability for it. So that's what we consider to be safe markets. I mean, we do keep our eyes out for different places in Europe and so forth, but quite often it'll come up that we fundamentally like a city or a market, but we can't rely on enough banks to be giving mortgage lending there, because they won't lend to expats, and that's largely, we've got a lot of people based currently in Europe, but it's where I'm based in the Middle East and where you're based in Hong Kong, it's expat buyers looking to buy into stable markets. And if we can't have a number of different banks lending their reasonable rates, then it's off our list, because we do believe in that still. And even in this inflation environment, I'm sure that if it hasn't been said yet, the question there would be as to, well, should I just buy in cash rather than taking a mortgage then? And no, for all the reasons, we can still leverage better. You're leveraging in a globally comparable, very stable market in the markets we look at, and therefore you can make money faster when still taking a mortgage, for a sensible period of time. We're not expecting our clients to buy and sell within 3 years. This is, buy and hold for 7 to 10 years and let the market do its thing, and see that inflation, realize your returns properly, and whilst you're protecting your capital from losing value just sitting in your bank account. So yeah, I mean, it takes a lot of research and effort and so forth, but this is what we do.
But Jeremy, just now you're talking about to mortgage or not to mortgage. Can I just check? I mean, I bought my place quite a few years ago with you guys in Manchester, and the gross yield roughly around sort of 4.5% to 5%, which is good, and I'm delighted. And actually, my rent has increased pretty much every year. But is that sort of gross yield still available in you showed a few regional cities just now. What is the gross yield? Because it'll be interesting to see if it's still above the mortgage rates, then it's a no-brainer, right, to mortgage.
Yeah, 100%. You can absolutely find that across the UK. We caveat this is the way we look at it is when we buy property, we're looking for that balance of an attractive yield and the potential for growth. And so yield is a direct reflector of risk, is what I always tend to tell clients. So, if you're searching for the highest possible yields that you're finding in a civilized area in the UK, you're probably maxing out at about 7, so it's still there. But actually the kind of properties we look at in areas which have, all the jobs and they are reasonably, priced and so forth. Yeah, you're right. Like Manchester and Birmingham, they're probably hovering around the kind of 4.5% to 5 to potentially 5.5%. And then on our next wave of cities that we're going into, then yeah, we can find 5.5 to 6%. And so yeah, it's absolutely achievable. And you're right, that does, compare well to the interest rates as the cost of the finance on the property still. So, London is obviously a lot lower than that, but it doesn't mean it's a bad investment to go into lower yield. You just have to have that potential to grow to make it worthwhile when you're going to leverage over a period of time.
Yeah, sure, understand. Okay, good to know. Thank you.
Just one for you here, Ian, perhaps. There's someone asking, I know you've sort of covered this, in terms of sort of interest rates, what would be your best guess for interest rates interest rate rises kind of tapering off a little bit? So in terms of we're in this environment of rates going up globally, it'd probably be for a little bit of time. But when you look at all the issues going on around the globe, what would be your thoughts in terms of when interest rate rises will level off?
Yeah, that's the $1 trillion question, right? Well, I'm not going to give you a figure. I mean, look, it also depends on which country and we're talking about. I'd say if we focus on the US and the UK, the UK has just come out a few days ago saying they are going to do it very gradually. It's going to be a steady, slow increase. Obviously, the Fed said that as well, and then we got the inflation figures a week ago, which were extremely high and beat expectations. So there's now talk that perhaps there will be a 75 basis point increase at the next meeting. So we'll have to wait and see. In terms of the sort of height and the persistence of it, though, look, it's going to have to move quite quickly. Inflation is clearly a lot higher than everyone thought. It was only a few months ago where pretty much everyone, or at least before the Ukraine conflict began, pretty much everyone said, yeah, inflation is just going to come and go. It's not going to be persistent. It's transitionary. Now, obviously, Russia invading Ukraine changed that significantly. But I think it will be quite quick. I mean, previous sort of consensus was in the sort of 3 to 3.5% level. It would surprise me if it's much higher than that. And assuming it does tame inflation, it would surprise me if it's kept at 3.5–4% for long. And I'll tell you why. Grant mentioned about the high interest rates in the 80s. I can remember before coming to Singapore, this is back in 2006, I can remember doing a cash deposit in pound sterling for 5% 1 year deposit. I mean, that's brilliant, easy money, right? But yeah, we're not going to see those days again. And I think I did touch on it before. It's simply that governments can't afford it. The global financial crisis hurt a lot of governments. You have the European debt crisis hurt all of the Eurozone. We've had COVID. These are all damaging things. You could argue, in fact, Europe hasn't properly recovered from all of that. So governments simply need money and they can't afford to service debt at 3.5–4%. I think it's as simple as that. So I think once inflation is tamed, I very much expect the rates to start going down again. But yeah, we'll see. I didn't answer your question on purpose, but yeah, exact level for each country, no idea, and time frame, no idea. But I would be surprised if we went past 3.5 to 4% in the US. And I'd be surprised if that stayed there for a long period of time, i.e. years.
Great, thanks, Ian. This is all recorded, so we can check on that down the line. See how active your predictions are. I'm sure they'll turn out to be very relevant indeed. So yeah, thanks, Ian.
Yeah, no problem.
Well, look, I mean, it's probably there are more questions here, but I think a lot of the major things which people need to hear have been covered now, and we will come back to you individually with the questions here. But I think the point we want to take away from here is that our money is depreciating, and there are better things to do than put it under the mattress. And what you want to do with that is completely up to you. But we are here for you, both Ian on the general financial advisory side, or Grant and I looking at the property side. So yeah, happy to help as and when you need. But thank you all for attending, and we'll look forward to speaking to you soon.